Mark here from Success with Options. In this set of videos, I'll be providing an overview of diagonal spreads. Now this is a strategy I haven't covered as much, but it is one that offers some pretty nice profitability when the market's trending. In this first video, I'll be demonstrating some diagonal spread concepts via slides. In a later video, I'll demonstrate trading diagonal spreads using the platform. Let's begin by talking about what a diagonal spread is. A diagonal spread is slightly different than many of the strategies I've covered in the past because it has both a time and a price component. You will buy an option several months out in time and sell an option in the front month, having a different strike price than the one bought. If you break the trade down, you will see that a diagonal spread is a combination of both a calendar spread and a vertical spread. The calendar spread portion is evident in the rolls that are performed. The vertical spread part is more obvious when the final roll is executed and you're left with a vertical spread. Due to the calendar spread component of the trade, diagonal spreads are positive vega. Also due to the vertical spread and calendar spread components, this trade is positive theta. There are actually two different types of diagonal spreads. Given the fact that the vertical spread is a component of the diagonal spread, can you guess why? The first type of diagonal spread is an in-the-money diagonal. It's more like a long position in that it will result in a long vertical spread when the final roll completes. In this type of spread, the ideal ending point is to have both strikes fully in the money on expiration. In that case, you will be able to sell the spread in an amount roughly equal to the width of the spread. Your cost basis is reduced by the credits received on the rolls. The other type of diagonal spread is an out-of-the-money diagonal spread. It's going to feel more like a short position because at the end you will have a short vertical spread and ideally both options will expire worthless. The goal in this case is to pick up enough credits on the rolls that it more than covers the initial debit and you make a profit. In this type of diagonal spread, it behaves much more like a calendar spread. Let's take a look at an example of an in-the-money diagonal spread. You'll start by buying a long call several months out. You'll want this option to be quite a ways in the money. In this case, let's say that you buy a May $59 call. Next, you'll sell a call in the current option month. Usually you'll want the short strike to be one or more strikes out of the money to give room for the underlying to move. In this case, let's say you sell a March $66 call. That leaves you with a $7 wide spread, which you'll put on for a debit that should be less than the width of the spread. Each month you'll want to roll the short strike to the next month and pick up a credit that will reduce the cost basis of the spread. The goal is to have the spread fully in the money near expiration on the final month. In this case, you'll sell back the spread and the profit in the trade will be the $7 for the spread minus the initial debit plus any credits received for the roll. Now let's look at an example of an out-of-the-money diagonal spread. You'll see right away as we go through this that it's a different sort of trade. First, we'll buy an out-of-the-money option several months out. In this case, let's buy a May $61 put. Next, we'll sell another out-of-the-money option in the current month but closer to the current price. This will result in a $2 wide spread. This trade will also be a debit trade, but it should be much less. However, there is going to be a margin set aside equal to the width of the spread, in this case $2. Like the in-the-money diagonal, we'll roll the short strike each month when near expiration of the current month. On the final month, the goal is for the trade to expire worthless. The total credits received on the rolls minus the initial debit is the profit. The objective is to receive more for the credits on the rolls than the initial debit paid to enter the position. Let's take a look at the in-the-money diagonal spread just a little more closely. This trade is going to behave much more like a covered call, but the cost of entry will generally be much less expensive. You'll want to buy a longer term option with a delta of around 0.7 to simulate the behavior of the underlying stock or ETF. You'll sell the front month option with a delta of around 0.3, much like you would for a covered call. When evaluating the trade, it should make sense without considering the rolls. That means that the width of the spread should be more than the cost of the initial debit. That way the credits received on the rolls make the trade even more attractive. The maximum loss on the trade is the initial debit minus any credits received for the rolls. The maximum gain will be the width of the spread minus the initial debit at a minimum, but it could be more with the credits received for the rolls. Now let's take a look at the out-of-the-money diagonal spread in more detail. This trade is going to behave much more like a calendar spread. It'll require a lower debit than the calendar spread but carries a margin instead. You'll want to sell the front month option with at least 20 days until expiration and having a delta of around 0.3. You will buy a back month option with at least 40 days until expiration. This position is largely to limit your loss, so your choice of strike price is going to be based on margin you're willing to tolerate and the initial debit for the position. You'll want to do some analysis, much like you would for a calendar spread, to determine if the potential credit for the rolls will be more than the initial debit. The max loss on the trade is the initial debit minus any credits received for the rolls. The maximum gain will be the initial debit minus any credits received for the roll. Let me wrap up this overview with a quick discussion of a strategy for trading a bullish in-the-money diagonal spread. You'll want to buy a call several months out with a delta of 0.7 to 0.8. At the same time, you'll sell a call in the month having between 20 and 30 days until expiration and having a delta of between 0.25 and 0.30. Your initial ROI should be at least 20% to make sense. That means the width of the spread minus the initial debit should yield a 20% initial profit. Calculate potential rolls in much the same way you would for a calendar spread. I've covered this in detail in several of the calendar spread videos I've uploaded, so I won't do so here. One thing to keep in mind is that you could roll to the next month, same strike, for a credit, or you could roll to the next month and up to a strike that has a delta of 0.25 to 0.30. In this case, you'll likely receive a smaller credit, or you may even pay a small debit. The benefit is your spread widens 1 or 2 points, which gives you a higher max gain. In terms of exiting the diagonal spread, there are a variety of ways of managing the exit. We want to make sure we absolutely close the trade one way or another before expiration. I like to do this 5 to 7 days prior to expiration. We could consider rolling the entire spread to a new position that would fit the parameters of a new trade. What happens is that we'll get a smaller credit on the roll, but we'll have a new trade with a much more favorable price. In any case, we'll want to make sure that we exit when the trade turns against us. This can be triggered by any number of different events. We could consider a technical exit like a break of support or some other technical indication, or we could also consider closing the trade with a limited loss. For example, we could say that if our trade loses half of its value, we'd be wrong and so we should exit. This has been a quick overview of diagonal spreads. In this video, I've covered basic concepts using slides. Be watching for another video to follow that will demonstrate the actual trade entry and management using a trading platform. I wish you success in your trading.